Hello and welcome. Today, we're diving into a topic that directly impacts the global economy, your investments, and all of our financial futures. The latest projections from the International Monetary Fund on global economic growth. The IMF, one of the world's most influential financial institutions, has just released its updated forecasts for 2025 and 2026. The news is a mix of cautious optimism and some important warnings we all need to understand. Have you ever stopped to think about how global economic decisions ripple down into your daily life? The price of groceries, job opportunities in your city, the value of your currency, the interest rates on your loans is all interconnected in this massive global economic puzzle. Before we jump into the specific numbers, let's set the stage. We are living through a truly unique moment in economic history. In just the last few years, we've navigated a pandemic that brought economies to a standstill, witnessed a major conflict in Europe that scrambled supply chains, experienced inflation at levels not seen in decades, and now we're seeing growing trade tensions among the world's economic superpowers. It's within this complex and challenging environment that the IMF has actually revised its projections upward. That's right, upward. Despite all the hurdles, the forecast is for 3.2% growth in the global economy in 2025. Now, that might not sound like a huge number at first, but given the turbulent times we're in, this figure represents something incredibly important: resilience. But what does this 3.2% growth really mean? To put it simply, when we talk about global economic growth, we're really talking about the increase in the total value of all goods and services produced by every economy on the planet. A 3.2% growth means that, as a whole, the world economy will be 3.2% larger in 2025 than it was in 2024. For developed economies, this might seem like a modest gain, but for emerging economies, it can translate into millions of new jobs, significant infrastructure improvements, and major progress in the fight against poverty. It's a single number that carries the hopes and challenges of billions of people. However, there is a crucial detail we can't overlook. This 3.2% projection for 2025 is followed by a forecast of a slight slowdown. For 2026, the IMF projects growth of 3.1%. It might seem like a tiny difference, just 1/10 of a percentage point, but in the vast scale of the global economy, that small fraction can represent billions of dollars and millions of opportunities gained or lost. This projected slowdown isn't just a random fluctuation. It reflects real, concrete concerns that IMF economists have identified in their analyses. And it's precisely these concerns that we're going to break down for you. The world is navigating some choppy waters, but it's not adrift. There are policies, strategies, and decisions being made right now that will shape our collective economic future. The more informed we are, the better decisions we can make as investors, entrepreneurs, professionals, or simply as engaged citizens. So, if you want to understand how these projections could affect you, your family, and your business, stick with me. We're going to uncover what's really behind these numbers, what the biggest risks on the horizon are, and what we can realistically expect in the coming years. But before we continue, if you're finding this content valuable, do me a quick favor and hit the like button and subscribe to the channel. It really helps us continue bringing you high-quality economic analysis. And don't forget to ring the notification bell so you won't miss any important updates on the economy and your investments. Now, let's get back to it. Let's dig deeper into the factors driving this 3.2% growth. What's powering this resilience? A big piece of the puzzle is the surprisingly strong performance of several key economies, most notably the United States. Despite facing high interest rates aimed at curbing inflation, the U.S. economy has shown remarkable strength, driven by robust consumer spending and a strong labor market. This has created a positive ripple effect across the globe. Another key factor is the gradual easing of inflation worldwide. While it's still a concern in many places, the general trend is that inflation is coming down from its peak. This gives central banks more breathing room. They can start to consider lowering interest rates, which makes it cheaper for businesses to borrow and invest, and for consumers to make large purchases, stimulating economic activity. Think of it like taking the foot off the brake pedal just a little bit. We're also seeing a stabilization in global supply chains. The massive disruptions we saw during the pandemic have largely subsided. Goods are moving more freely around the world, which helps to lower costs and ensure the products are available on shelves. This return to normalcy is a fundamental building block for stable economic growth. However, this optimism is not evenly distributed. The IMF's report highlights a growing divergence between different regions of the world. While some economies, like the US, and several emerging markets in Asia, are performing well, others, particularly in Europe, are facing more significant headwinds. Germany, for example, a traditional powerhouse of the European economy, has been struggling with high energy costs and weak external demand for its manufactured goods. This creates a multi-speed global economy, where some are sprinting ahead while others are lagging behind. This divergence is a major source of uncertainty and potential instability. Now, let's talk about that projected slowdown to 3.1% in 2026. Why are economists tapping the brakes on their optimism for the year after next? The IMF points to several significant risks that could derail the recovery. The first, and perhaps most significant, is the persistence of high public debt. Governments around the world took on massive debt to combat the economic fallout of the pandemic. Now, they face the difficult task of paying it back. This can lead to tough choices, like cutting public spending or raising taxes, both of which can slow down economic growth. High debt levels also make economies more vulnerable to shocks. Another major risk is geopolitical fragmentation. We're seeing a rise in trade disputes, sanctions, and a general move away from global cooperation. This trend towards friendshoring, where countries prioritize trade with allies, can make supply chains less efficient and more expensive. It disrupts the free flow of goods, capital, and technology that has powered global growth for decades. This fragmentation can lead to a more divided and less prosperous world economy in the long run. And, of course, there's the ongoing challenge of inflation. While it has eased, the fight is not over. There's a risk that inflation could prove stickier than expected, forcing central banks to keep interest rates higher for longer. This would continue to act as a drag on economic activity, making it harder for businesses to grow and for households to manage their finances. The path to bringing inflation back to target without causing a recession is a very narrow one, and there's no guarantee of a soft landing. So, what does all of this mean for you as an individual? How can you navigate this complex economic landscape? First, for your personal finances, it underscores the importance of having a solid financial plan. In an environment of uncertainty, having an emergency fund is more critical than ever. It provides a cushion against unexpected job loss or financial shocks. It's also a good time to review your budget and look for ways to manage your expenses, especially as the cost of living remains elevated. For investors, this environment calls for a diversified and long-term approach. The divergence between economies means that some markets may perform much better than others. A well-diversified portfolio, spread across different asset classes and geographic regions, can help to mitigate risks. It's also important to remember that market volatility is likely to continue. Trying to time the market is a fool's errand. Instead, focus on your long-term goals and stick to your investment strategy. The resilience shown by the global economy is a reminder that, over the long term, investing in productive assets is a proven way to build wealth. For business owners and professionals, this is a time for agility and strategic planning. The changing geopolitical landscape may require a rethinking of supply chains. The persistence of inflation means that managing costs will remain a top priority. But the projected growth also presents opportunities. In a growing economy, there is demand for new products and services. Identifying those areas of growth and positioning your business or your career to take advantage of them will be key to success. This might mean investing in new technologies, developing new skills, or exploring new markets. The key takeaway from the IMF's latest report is one of cautious optimism tempered by a healthy dose of realism. The global economy has proven to be more resilient than many expected, but the path ahead is fraught with challenges. The decisions made by policymakers in the coming months on interest rates, on public debt, and on international trade will have a profound impact on the economic trajectory for years to come. As informed citizens, it's crucial that we stay engaged and understand these issues. The global economy isn't some abstract concept. It's the framework that shapes our lives and our opportunities. By understanding the forces at play, we can make better decisions for ourselves, our families, and our communities. We can advocate for policies that promote sustainable and inclusive growth, and we can prepare ourselves to navigate the uncertainties that lie ahead. Thank you so much for joining me for this deep dive into the global economy. I hope you found this analysis helpful and that it gave you a clearer picture of the economic landscape we are all a part of. If you have any questions or thoughts, please drop them in the comments below. I love hearing from you and will do my best to respond. Don't forget to like this video if you enjoyed it, and subscribe to the channel for more content like this. Thanks again for watching, and I'll see you in the next video. Have you seen the latest headlines about the global economy? The IMF is projecting a 3.2% growth for 2025, and you might be thinking, okay, what does that number even mean for me? Well, let's break it down together, because that single number hides a fascinating, complex story about what's really happening from the US to China and everywhere in between. First, it's crucial to understand that global growth is a weighted average. It's like a class average grade. Some students are acing it, while others are struggling. So, while the global average is 3.2%, some countries are growing much faster, and others are barely moving or even shrinking. Let's start with the big one, the United States. As the world's largest economy, the US is still on solid ground. Projections show strong growth thanks to a healthy job market, big investments in technology and infrastructure, and people like you and me still spending. But there's a catch. The US is walking a tightrope, trying to balance this growth with controlling inflation. The Federal Reserve has kept interest rates high to cool down prices. This makes borrowing money more expensive for everyone, which can slow down business investments and consumer spending. But it's the price to pay for economic stability. Now, let's hop across the Atlantic to Europe. The situation in the Eurozone is a bit more complicated. The continent is still grappling with the high energy costs stemming from the conflict in Ukraine. On top of that, an aging population is putting a strain on social systems, and they're facing fierce competition from Asian economies in key industries like car manufacturing. Germany, which has long been Europe's economic powerhouse, is showing signs of weakness. Its old model, which relied heavily on cheap energy and massive exports to China, is now revealing its vulnerabilities. France and Italy are also navigating tricky financial situations and need to make some big structural changes. But it's not all doom and gloom. Countries like Spain and Portugal are showing impressive resilience, but their economy is growing faster than the European average. Next up, the giant in the room, China. For years, analysts have been watching China with a mix of awe and uncertainty. We all remember the days when China's economy was booming, growing at incredible rates of 8, 9, or even 10% a year. Those days are over. China is now shifting gears into what's being called the new normal, a more moderate, sustainable growth model. The challenges are huge. They're carefully managing a massive real estate bubble, dealing with high levels of debt, navigating trade tensions with the US, and facing a serious demographic crisis as its population ages and starts to shrink. For 2025, China's growth is expected to be around 4.5% to 5%. For most developed countries, that would be fantastic, but for China, it's a major slowdown. And when China slows down, the whole world feels it. Countries like Brazil, Australia, and many in Africa that export raw materials to China see less demand. Multinational companies that depend on Chinese consumers also feel the pinch. This brings us to the emerging and developing economies. This is a huge, diverse group of countries. Think India, Brazil, Indonesia, Mexico, and many more. As a whole, this group is a bright spot, projected to grow by over 4% in 2025, outpacing the developed world. India, in particular, is one to watch. Its population has now surpassed China's, and it has a massive young workforce. With significant investments in infrastructure and a booming tech sector, India is on track to be one of the fastest growing major economies in the world, possibly expanding by more than 6% a year. Then there's Brazil, Latin America's largest economy. It's a country with immense potential, rich in natural resources, a world-class agricultural sector, and a diverse industrial base. However, ongoing fiscal challenges, political instability, and the need for deep reforms create a layer of uncertainty that could hold back its growth. Now, here's a crucial reality check. All of these numbers we've been discussing for the US, Europe, China, and everyone else come with a big asterisk. They are based on sophisticated economic models, yes, but they also rely on a huge assumption that nothing major goes wrong. The IMF's projections are for a baseline scenario. They assume no new major geopolitical conflicts, no new pandemics, and no sudden financial crises. But as we all know, reality rarely sticks to the script. That's why it's so important to not just look at the headline number, but to also understand the risks lurking beneath the surface. These are the potential threats that could derail the global economy, and we're going to dive deep into those risks in the next part of our analysis. But before we do that, I want to hear from you. After hearing this breakdown, are you feeling more optimistic or pessimistic about the global economy in the coming years? Which part of these projections worries you or excites you the most? Drop your thoughts in the comments below. Let's get a real conversation going. Thanks so much for watching, and if you're finding this useful, don't forget to like this video and subscribe to the channel so you don't miss what is coming next. See you in a bit. What really keeps economists awake at night? It's the risks that could completely derail global growth right now. According to the IMF, the massive storm clouds are hanging over the world economy. Trade tariffs and geopolitical tensions. For decades, the world seemed to be moving in one clear direction: more trade, fewer barriers, and deeper globalization. The logic was simple and powerful. If every country focuses on what it does best and everyone trades freely, then everyone wins. You get more efficiency, more growth, and more prosperity for all. It seemed like a no-brainer, but that global consensus has started to crumble. The turning point really came in 2018, when the United States kicked off what we now call the trade war with China. Tariffs were slapped on hundreds of billions of dollars worth of Chinese goods, and China, of course, hit back with its own tariffs on American products. This back and forth created a cycle of retaliation that continues to shape global trade relations to this day. And it didn't just stop with China. Tariffs on steel and aluminum also hit traditional US allies like the European Union, Canada, and Mexico. Europe didn't take this lying down. They responded with their own tariffs and even introduced new regulations, like the Carbon Border Adjustment Mechanism, which adds another layer of complexity to trade. So, why does all this matter so much? Because tariffs make everything more expensive and less efficient. Think about it. Imagine a company that designs a smartphone in the US, buys its chips from Taiwan, its screens from South Korea, its batteries from China, and then assembles the final product in Vietnam. This entire supply chain was meticulously built for one thing: maximum efficiency. Now, start adding tariffs at every border crossing. Suddenly, every single step becomes more expensive. The company is left with a few bad options. It can either absorb those extra costs and watch its profits shrink, pass the costs on to you by raising prices, or try to completely reorganize its entire global supply chain. None of these choices are good for global growth. Now, multiply that single smartphone company by thousands of other products and millions of companies all around the world. The result is simple: less trade, less efficiency, higher prices for everyone, and slower economic growth. The IMF has run the numbers, and their estimates suggest that a significant rise in tariffs could shave several tenths of a percentage point off global growth. That might not sound like a lot, but in a global economy worth over $100 trillion, that's hundreds of billions of dollars in lost wealth. It's a huge deal. But if tariffs are a major concern, geopolitical tensions are even more alarming. The world today is more geopolitically fragmented than it has been in decades. We have the ongoing war in Ukraine, which is having a profound impact on global energy and food security. We have rising tensions in the South China Sea, with disputes involving China, the Philippines, Vietnam, and other nations. We have persistent instability in the Middle East, which can disrupt energy markets at a moment's notice. And then there's the issue of Taiwan, a potential flashpoint, with absolutely catastrophic economic consequences. Why is Taiwan so critical? Because that one island produces over 60% of the world's semiconductors, and a staggering 90% of the most advanced chips. Any disruption there, whether it's from a conflict, a blockade, or sanctions, could trigger a semiconductor crisis that would make the shortages we saw a few years ago look like a minor inconvenience. Think about it: modern cars, smartphones, computers, life-saving medical devices, and even advanced defense systems all depend on these chips. A major shock to this supply chain could vaporize trillions of dollars from the global economy. The ripple effects would be felt everywhere. But it's not just about the risk of potential conflicts. We're also witnessing what some experts call the weaponization of economics, the use of trade and finance as geopolitical tools. After Russia's invasion of Ukraine, the West imposed unprecedented sanctions. In response, Russia used its vast energy resources as leverage against Europe, and China has shown it can exert influence through its dominance over rare earth minerals and other critical materials. These developments create what economists refer to as tail risks. These are low-probability events, but they have extremely high, devastating consequences, and the more geopolitical tensions rise, the higher the chance that one of these tail risks actually becomes a reality. The IMF is making it very clear. These are not just abstract concerns for economists to debate. They are already actively reshaping the global economy right now. We're seeing companies moving their production, not for efficiency anymore, but for security. This trend is called friendshoring or nearshoring, where businesses move their operations to countries that are politically aligned or geographically closer. Foreign investment is now being scrutinized through a national security lens. Critical technologies are facing stricter export controls. All of this might make the world a bit more resilient to certain shocks, but it also makes it a lot less efficient, and that means slower growth than what we could achieve in a more cooperative, globalized world. But the story doesn't end here with just tariffs and geopolitics. There are other powerful forces at play that are shaping our economic future. In the next video, we'll dive into how massive demographic shifts and incredible technological revolutions are completely redefining the world economy. Thanks so much for watching. If you found this interesting, don't forget to hit the like button, subscribe to the channel, and ring the bell so you don't miss our next exploration into the forces shaping our world. See you in the next one. We've covered tariffs and geopolitics, but the global economic story is so much bigger. To understand if we'll hit the 3.2% growth target in 2025, we need to look at deeper forces. First, demographics. Developed nations like Japan, Europe, and now even China face aging and shrinking. Population's economic growth needs more workers or more productivity. With fewer workers, the pressure is on. Meanwhile, places like India, and sub-Saharan Africa have a youth boom. This demographic dividend is huge potential, but only if it's met with education and jobs. Then there's technology, especially AI. It's not sci-fi anymore. It's a game changer boosting productivity across industries, from medicine to manufacturing. Billions are being invested, and we're already seeing results. The flip side, it could widen the inequality gap and is a key battleground in the US-China tech race. The future is complex, so stick around and subscribe as we untangle it all. After everything we discussed, the IMF projections, the risks, the opportunities, what does it all really mean for you, for your finances, your career, and your future? Let's put it in perspective. A global growth rate of around 3% isn't the boom we saw before 2008, but it is not a recession either. This is the new normal, moderate, positive growth. The world is transitioning. We're moving from an era of rapid globalization to one that's more fragmented and cautious. From cheap energy to a complex green transition. From favorable demographics to aging populations. This isn't a catastrophe, but it requires us to adapt. And here's a crucial truth. In a world of moderate growth, the gap between winners and losers widens. When growth is strong, everyone does well. But in a slower environment, quality, adaptability, and innovation matter more than ever. So, what does this mean for you as an investor? First, diversification is no longer just a good idea, it's essential. Spreading your investments across different countries, sectors, and asset classes is your best defense against geopolitical and economic risks. Second, you need to understand the long-term structural trends. Where is the growth, even in a moderate world? Think technology, especially AI, the energy transition and clean tech, healthcare and biotech, driven by aging populations, infrastructure in emerging economies, and, of course, cybersecurity. On the flip side, some traditional sectors, like brick-and-mortar retail and fossil fuels, face serious headwinds. Third, quality is king. Look for companies with strong balance sheets, low debt, and competent management. Speculative bets are far more dangerous when the economic tide isn't lifting all boats. Now, what about your career? The same lessons apply. Skills that can't be easily automated, like creativity, critical thinking, and emotional intelligence, are becoming more valuable at the same time. Being proficient with tools like AI is quickly becoming a basic requirement. The key word is adaptability. The skills you have today might not be as relevant in 5 or 10 years. Continuous learning isn't optional anymore. It's essential for staying relevant. So, where are the opportunities geographically? Asia, despite some challenges, remains the world's growth engine, with countries like India, Vietnam, and Indonesia showing significant potential. Africa has the youngest population and fastest urbanization rate globally, representing enormous long-term potential, though it's not for the risk-averse right now. Europe offers stability and leadership in green tech, even with slower growth, and the United States continues to be an innovation powerhouse, despite its own internal challenges. For my friends in Latin America, especially Brazil, you're at a crossroads. The region has the natural resources the world desperately needs. For Brazil, turning that immense potential from agriculture to clean energy into reality depends on sound economic policy and reforms. Underlying all of this is one big theme: uncertainty. The world is fundamentally more unpredictable than it was 20 years ago. So, how do we deal with that? First, build resilience. A plan that works reasonably well in different scenarios is better than a perfect plan for just one. Second, create optionality. Keep your options open and avoid irreversible decisions. Third, focus on what you can control: your skills, your savings, your investment strategy. And finally, practice humility. Accept that we can't know everything, and be ready to change your mind as new information comes in. So, are the IMF's projections good or bad news? The honest answer is, it depends. It's disappointing for those hoping for a boom, but reassuring for those fearing a crash. What is clear is that this new era of moderate growth demands more from all of us. More adaptability, more learning, and more careful decision-making. But let's end on this note. Despite all the challenges, we live in an age of extraordinary possibility. Technologies that were science fiction a generation ago are now reality. Knowledge is more accessible than ever. Moderate growth is still growth. It's still progress. Perhaps it's time we recalibrate our expectations and recognize that solid, sustainable growth is a very positive outcome. So, stay informed, keep learning, adapt, and diversify. In this new world, your informed decisions make all the difference. If you enjoyed this deep dive, don't forget to subscribe, like, and hit the notification bell. Share this with anyone who wants to understand the economic forces shaping our world. And let me know in the comments, what part of this outlook impacts you the most? Are you optimistic or cautious? Your feedback helps me create content that truly matters to you. Thanks for watching. Remember, in a world of constant change, knowledge is power, but applied knowledge is transformation. See you in the next video.